Interest rates are still high after years of hikes, so what does that mean for your wallet today? Spoiler, it's complicated, but don't worry. We're about to make it almost as fun as realizing sale prices are just the original prices from 2019. Here we take confusing money stuff and turn it into, hey, I actually get this. This is Captain Clue reporting, government accountant and finance specialist. Today, we're tackling the thrilling world of rising interest rates. You've seen the dramatic headlines, Fed strikes again. But what does it really mean for your bank account, your mortgage, and that suspiciously cheap luxury coffee maker you financed? We're breaking it all down, minus the economy professor vibes. By the end of this, you'll be the most interesting person at happy hour, or at least the one who knows why everyone's suddenly complaining about their car payments. First off, interest rates are essentially the cost of borrowing money or the reward for saving or lending money. Think of it like this. Interest is the price of money. Just like there's a price for a gallon of milk or a new phone, there's a price for borrowing money. That price is the interest rate. When you borrow money, you pay interest to the lender. When you save money in a bank, the bank pays you interest for the privilege of using your money. Simple enough, right? Well, it gets a little more complicated. Big picture-wise, central banks like the Federal Reserve in the US and the Bank of Canada are the big players. These institutions are like the conductors of the economic orchestra. They have a mandate to keep the economy stable and humming along. One of their main tools to do this is by controlling interest rates. Specifically, they control the rate at which banks can borrow money from each other in the short term. This is often called the federal funds rate in the US or the policy rate in Canada. Think of it as the base rate, and it influences all the other interest rates you see every day. Here's the thing. Why do central banks even bother with this? Well, it's all about managing the economy. Imagine the economy is a car. Sometimes it needs a little gas to speed up, and sometimes it needs the brakes to slow down. Interest rates are the gas and the brakes. When the economy is sluggish and they want to encourage growth, central banks lower interest rates. This makes borrowing cheaper, which encourages businesses to invest and consumers to spend. More spending means more economic activity and hopefully more jobs. Here's where it gets interesting. What happens when the economy starts to overheat? That's where rising interest rates come in. When there's too much money chasing too few goods and services, you get inflation. Prices go up. To cool things down, central banks raise interest rates. This makes borrowing more expensive, which discourages spending and investment. Less demand can help bring prices back down. It's a delicate balancing act, and sometimes it feels like they're trying to park a car on a steep hill. Now, let's get into how this affects you directly. Let's talk about savings accounts. When interest rates rise, the good news is that savings accounts should start offering higher interest rates. And this means you earn more money just by keeping your money in the bank. It's like getting paid to save. In a low interest rate environment, your savings might not even keep up with inflation, meaning your money is effectively losing value. But with higher interest rates, you can potentially earn a real return on your savings. It's a win. More importantly, it's not all sunshine and rainbows. Rising interest rates also have a significant impact on borrowing. Think about loans, car loans, student loans, and especially mortgages. When interest rates go up, the cost of borrowing increases. This means you'll pay more in interest over the life of the loan. For example, if you're planning to buy a house, a higher interest rate can significantly increase your monthly mortgage payment, potentially making it less affordable. That can really put the squeeze on your monthly budget. Switching gears, the housing market is particularly sensitive to interest rate changes. When rates rise, demand for houses tends to cool down because mortgages become more expensive. This can lead to a slowdown in the housing market, with prices potentially stabilizing or even decreasing in some areas. So if you're a seller, you might not get as high a price as you would in a low interest rate environment. But if you're a buyer, you might have more negotiating power and find more affordable options. It's a mixed bag. Let me break this down. The stock market can also be affected by rising interest rates. Generally, higher interest rates can put downward pressure on stock prices, at least in the short term. This is because higher interest rates make borrowing more expensive for companies, which can reduce their profitability. Additionally, higher interest rates make bonds more attractive to investors as they offer a fixed income stream. This can lead to some investors shifting their money from stocks to bonds. However, it's important to remember that the stock market is influenced by many factors, and interest rates are just one piece of the puzzle. In the long run, the stock market has historically tended to adjust and continue its upward trend. Think of it like this. Bonds are another area where interest rates play a crucial role. If you already own bonds, rising interest rates can actually make them less valuable. Here's why. Bonds pay a fixed interest rate called a coupon. If new bonds are issued with higher coupon rates, your older bonds with lower coupon payments become less attractive to investors. I mean, who wants a 4% bond when a 6% one is right there? This can cause the price of older bonds to fall. However, the flip side is that as new bonds are issued, they will offer higher interest rates, which is good news for bond investors looking for income. So what does this all mean? We've covered a lot. We know that rising interest rates impact savings, loans, the housing market, stocks, and bonds. But here's the real challenge. How do you navigate all of this? It can feel like you're trying to sail a boat in a storm. Lots of conflicting information, and it's hard to know which way to steer. Many people feel overwhelmed and confused, and that's completely understandable. It's easy to make financial mistakes when you're not sure what's going on. For example, someone might panic and sell all their stocks at the first sign of a rate hike, locking in losses, or they might take on a mortgage they can't really afford, setting themselves up for financial stress. Here's how we tackle this challenge. Let's start with some practical steps. First, knowledge is power. Understanding the basics of interest rates, like we've discussed, is the first crucial step. Don't just rely on headlines, dig a little deeper. Read reputable financial news sources and consider talking to a financial advisor if you need personalized guidance. Next up, it's essential to have a solid financial plan. This is like your navigation map for your financial journey. A good plan will take into account different scenarios, including rising interest rates. It will help you prioritize your goals, manage your debt, and make informed investment decisions. If you don't have a financial plan, now is the perfect time to create one. There are many free online resources and tools available to help you get started. Moving on to managing your debt wisely. In a rising interest rate environment, it's more important than ever to keep your debt levels under control. Focus on paying down high interest debt, like credit card debt, as quickly as possible, unless it's absolutely necessary. If you're considering a major purchase, like a house, carefully evaluate your budget and ensure you can comfortably afford the payments even if interest rates continue to rise. More importantly, diversify your investments. Don't put all your eggs in one basket. Diversification is key to managing risk, especially in volatile times. Spread your investments across different asset classes, such as stocks, bonds, and real estate. This can help cushion the impact of interest rate changes on your overall portfolio. Consider investing in index funds or ETFs, which offer broad diversification at a low cost. Last but not least, keep your cool and don't freak out. The financial markets can be unpredictable and there will be ups and downs. Don't make emotional decisions based on short-term fluctuations. Stick to your long-term financial plan and remember that investing is a marathon, not a sprint. If you're feeling anxious, take a break from checking your investment accounts and focus on other aspects of your life. Avoid costly finance mistakes. Finance Fiascos Volume 1 Raw Confessions plus Mind Map PDFs for bite-sized quick review of these videos. Use code CLUE10 for 10% off today only. Let's illustrate this with a story. Imagine two friends, Sarah and John. Both of them bought houses around the same time. Sarah got a variable rate mortgage, thinking interest rates would stay low forever. John, on the other hand, opted for a fixed rate mortgage, even though it had a slightly higher initial interest rate. When interest rates started to rise, Sarah's monthly payments increased significantly, putting a strain on her budget. She started to panic and considered selling her house. John, however, was able to sleep soundly at night because his payments remained the same thanks to his fixed-rate mortgage. This story highlights the importance of understanding the risks and rewards of different types of loans and making informed decisions based on your individual circumstances. Another example is investing in the stock market. Let's say you invested a significant portion of your savings in tech stocks. When interest rates started to rise, tech stocks, which are often considered growth stocks, experienced a downturn. If you panicked and sold your shares, you would have locked in your losses. However, if you had diversified your portfolio by including investments in other sectors, such as healthcare or consumer staples, your overall portfolio would have been less affected. This illustrates the importance of diversification and staying calm during market fluctuations. To recap, rising interest rates impact various aspects of your financial life, from savings and loans to the housing market and investments. While they can create challenges, they also present opportunities. The key is to understand how they work, manage your debt wisely, diversify your investments, and stay calm during market fluctuations. By taking these steps, you can navigate the complexities of rising interest rates and achieve your financial goals. It's all about being proactive, not reactive. Think of yourself as the captain of your financial ship, charting a course through the ever-changing economic seas. If you found this video helpful, please hit the like button and subscribe to the channel for more financial insights.